Right. Yes, good morning to all of you online students. Can you all hear me properly?
Yes, sir. Good morning.
Right. Good morning to all of you. Right. Okay. So how's the life going on? Right. Okay. So now I think you all can see the PowerPoint which I have shared as well. Okay. Fine. So now we are in which week? We are in which week? Okay. Fine. Good. Now if you go to LMS, I have uploaded your first group activity, right? First group activity, and the submission date is also given. Small 5 questions related with time value of money. So you have to submit as a group that particular assignment on the given deadline, right? Then your group assignment. Hope you remember that the thing that I have told you last week and will be uploaded, right? I just got to know that I received the email from the batch coordinator about your group segregations, number of tier groups that you have. So based on that, I will upload your group assignment within 2 or 3 hours during your interview. Okay, so that is your group assignment. So you have two group activities and a group assignment. One group activity has been already uploaded to LMS and the submission date is also given. Then the group assignment will be uploaded today, and your second group activity will also be uploaded within the by providing the deadlines as well. Okay, fine. Right. So today, our objective is what? Now we have started discussing about cost of capital. So today we are going to complete this. Right. Today we are going to complete this cost of capital. Thereafter, I will fully explain about your group assignment. What you have to do from starting point to the ending point. Everything. Right. So because of that, you can get some sort of an understanding. The assignment is very simple, but this understanding process is quite difficult. That's the issue. Assignment is easy because I know it's maximum, if I have not mistaken, without considering your cover page, title page, content page, then references, your group report may be for only for 6 pages. Only for 6 pages, if I'm not mistaken. Right. So that much of very small assignment is there, but the thing that you have to do is a little bit big. Okay, so that is our objective. First, we are going to complete the cost of capital lecture material and the lesson. Then we are going to look at that part as well. Okay. Yes, online students, are you clear with the objectives? Is that fine? Is it
Yes,
okay?
sir. Yes,
Right.
sir.
Okay, fine. Good. Recording, no? Red indicates recording. Right. Okay. So we'll move now. Yesterday, last week, you got to know what is cost of capital. That is simply the minimum return which is expected by your investors. So the funds they have provided to the government, right? Minimum required rate of return or minimum rate of return that they expect from the company for the funds that they have invested, right? For the funds that they have invested, right? Right. So there is cost of capital, simply the minimum rate of return that the investor expect by providing the funds for their company. Then we had a deep discussion about this cost of capital part in last week. Then we started discussing about what is sources of finance, from where you are going to get the finance, so how we can categorize this, right? Thereafter, we started introduction to component cost of capital, and this is the part where you have learned about what is cost of capital and what is component cost of capital. What is the difference between them in a very practical way, right? Then we started categorizing our financial instruments based on the risk and return. And first you have risk-free securities, then corporate debentures, thereafter you have preference shares and equity shares, right? So then we started doing our calculation. Uh, as I told you, when it comes to the capital structure, we have debt components as well as equity components. We started with debt components, starting with bonds. Thereafter, we are going to go with preference shares, which is very easy. Now, when it comes to the bonds, we have completed the discussion of how to calculate the cost of a bond if the bond is issued at a par value. Then how to calculate the bond if the bond is issued at a premium, right? At a premium. Okay, so those are the things that we have done up to now. Right, so you got to know what is a bond, and you know what is bond because we have completed that part in the valuation as well. But here we refresh our mindset again by reading the things. And these are the formulas that we have used. And now today we are going to calculate the cost of irredeemable debentures, right? Cost of irredeemable debentures. Actually, hiddenly you have done the calculation for cost of redeemable debentures. Redeemable means after some time the company is going to release the bond. You have done that calculation. If you look at that IRR, that is something similar to that. Okay, so now here we are going to look at how to calculate the cost of a irredeemable debenture. Irredeemable debenture. Now, what it means by irredeemable? Irredeemable means what? Redeemable means what? Redeemable? Yes, redeemable. Yes, at the end of the match. First thing is that when you come to the redeemable debentures, you have a maturity period. So after that maturity period, you are going to release or redeem the bond. Accordingly, the bondholder will have the maturity value as well as the coupon amounts during that holding period when it's come to redeemable bonds. But when it's come to a redeemable bond, what happens? Do you have a maturity period? No, you don't have a maturity period. Right? Something like perpetual bonds. If you have noticed that when it comes to the valuation, finally we discuss about perpetual bonds. It's something like the irredeemable bond. You don't have a maturity period, but the bondholder may get or will get what? Coupons. Simply coupons. So what we have to do, we have to consider it as a perpetuity, annuity that you are going to get till the maturity till the end of your life cycle. So simply we need to divide your interest from the book value of the bond, right? Interest from the book value of the bond. For an example, I don't have the calculation for this because it's very much easy. So let's say, right, the face value of the bond is 1,000 rupees, right? The face value of the bond is 1,000 rupees, and the coupon rate is 10%. You don't have a maturity period. Why? There is a irredeemable bond, right? Accordingly, your coupon amount is how much? It's face value into coupon rate divided by book value or the market value of the bond. Here, let's take more last name. It's 1,000 and the value is 10%. Very simple, right? Very simple. Cost is 10%. Okay, cost is 10%. Is that clear? Right? So this is how you calculate the cost of a irredeemable bond where you don't have a maturity period, right? You don't have a maturity period, right? Uh, I think we have completed only question number up to question number 2. Am I correct in your tutorial? Right. So now you know how to calculate the cost of a bond if it is issued at par. You know how to calculate the bond if the bond is issued at a discount or redeemed at a premium. How to calculate the cost of a bond, simply a irredeemable bond or irredeemable debenture, right? Then you are going to know how to calculate the cost of redeemable debentures as well as convertible debentures, right? Debentures, bonds, consider it as a synonyms, but there's a difference between them, but the calculation is somewhat same, right? Now, here simply we are going to look at how to calculate the cost of a convertible bonds, right? Convertible bonds. Redeemable bonds, anyway, you know, if you have a maturity period, how to calculate the value based on that IRR. Now, if you look at these convertible bonds, what happens is after some time, bondholder may get an option to convert his bondholding into equity shares, right? Bondholding into equity shares. So at the beginning of this agreement, they issue the bond called a convertible bond. Not a normal type of a bond. It's a convertible bond where the company gives the option with conversion, right? Conversion option. So at the end of the maturity period, as a bondholder, you can decide whether to get the amount that you have invested or to convert your bondholding into what? Equity holding. Accordingly, what happened? Debt holder become an equity holder in that company. So that is the option that the company provides to you. So it is your choice to exercise that option. That is the technical word. That is your choice to exercise that particular option, either to get the amount as it is, or to convert your position into from bond to equity. Clear? Right. So that is the simple understanding about convertible debentures, right? Or a bond. So we'll do a calculation to get the more understanding about this. Right. Okay, now if we look at question number 3, if we look at question number 3, this is what we have to do. Right. So what does it say? It says one of the bondholder, right? Example, one of the bondholder, is given the option to convert the bonds into 200 ordinary shares at the end of the 5th year or accept 1,000 cash. That is the first statement. First, you need to understand the statements very well. Otherwise, it is really difficult. Right? One of the bondholders is given the option to convert the bonds into 200 ordinary shares at the end of the 5th year or accept 1,000 rupees as cash. By looking at these particular statement, what are the features that you can identify in a bond? What are the features? So, face value, coupon rate, then the maturity period, redemption value. Those are some of the features that you can identify by looking at a particular bond. Now, if you look at this first statement, what are the features that you can identify in this bond? Yes? Features? Yes, conversion option is there. So at the very beginning, you can say yes. Could be a convertible bond. Could be a convertible bond. So what are the other features? Yes, you can understand the maturity period. N is how much? It's 5 years. N is 5 years. Yes, further, you can identify redemption value for the maturity value. Good. Redemption value for the maturity value, that is equals to 1,000. Redemption for the maturity value, that is equals to 1,000. Okay. So which means the company has issued a convertible bond which could be exchanged for 200 ordinary shares, right? So bondholder can exercise that particular option, or he can get the 1,000 and say tata bye to the company, right? That is the first statement. Here it says the forecast price of a share in 5 years is 6 rupees. So simply it says, we'll understand why it is given. Market price per share in the 6th year is equals to 5th year is equals to 5 rupees, right? 5 rupees. Sorry, 6 rupees. Market price per share in the 5th year equals to 6 rupees. Clear? Then the current value of the debenture, right? The market value of the debenture is equals to 1070.59. 1070.59. The bond will be redeemed at par. Okay, we know it. That is why here its redemption value as given like 1,000, right? The bond will be redeemed at par, and the coupon rate is 12%. Coupon rate is 12%. Coupon rate is equals to 12%. The tax rate is 30%, right? Tax rate is 30%, and this is a bond with the conversion option, right? Conversion option is there. Conversion option is there, right? Conversion option is there, right? So if I summarize this entire question to you again, company has given an option to one of their bondholder to convert his bond holding into equity holding after the maturity period, or accept his invested amount per bond. So the maturity period is 5 years and the redemption value is 1,000. Then the forecast price of the share at the end of the maturity period has been given. Market price per share in the 5th year is equals to 6 rupees. And the market value of the bond is given. It's the 1070.59, as well as coupon rate, and the tax rate is given. So what you have to do, you have to calculate simply the cost of the bond or the cost of the debenture, right? You have to calculate this. So you know how to calculate this, am I correct? Cost of a bond, you know how to calculate this. How you calculate this? Simply, we know that IRR, right? Based on the IRR, we are going to calculate the cost of the bond, right? So accordingly, simply you need to open that particular table, right? So description is there, right? You have your description, then you have the cash flow, right? So after that, you have your annuity factor or the discount factor, then the present value. Okay. Again, we need to have another annuity factor or the discount factor, because you know when it comes to IRR, you need to use PVs. Then again, the present value. Okay. Then again, the present value. Then what happens? Right? What happens? Now, at the very beginning, what happens? At the very beginning, so you pay the market value of the bond and you purchase it, right? You are paying the market value of the bond and you purchase it. So the market value is 1070.59 minus. Then what happened? During the period, you are going to get the coupon amount, right? During the period, you are going to get the coupon amount. So how you calculate the coupon? It's 1,000 into 12%, 1 minus tax rate. 1 minus tax rate. Okay. 1,000 into 12 is 120. 120 out of 120, 70% means how much? Yes, 1 out of 84. Right. The coupon amount equals to 84. Right. The coupon amount is equals to 84. Right. Up to now, okay. Right. Now, then what happens here? You need to consider about either redemption or that particular option, whether to convert your bonds into equity, right? Still, we cannot write anything here because we don't know what will happen, right? Now, let's do something like this. So, redemption value of the bond, right? Redemption value of the bond is how much? It's 1,000 rupees, right? Redemption value of the bond is 1,000 rupees, meaning that if you wish to accept the invested amount per bond, you are going to get how much? 1,000 rupee per bond. And on the other hand, you have something called conversion value. Conversion value. Conversion value. We are going to calculate something called conversion value. Now here it says one of the bondholder is given the option to convert the debentures into 200 ordinary shares at the end of the 5th years, which means if you do not accept this 1,000 rupee per bond, what is your option? You are going to convert your bonds into shares. Is that clear? That is what it says. You are going to convert your bonds into shares. Right? So how many shares? 200 shares. 200 shares per bond. 200 shares per bond. Now here you have the value of the bond, but here you have only the amount of shares. So you need to make this one as well as this one in terms of values. Right? Here also given as value, you need to convert this into a value as well. Then, what is the market price of the share at the end of the maturity period? Huh? How much? It's 6 rupees. Market price per share at the end of the maturity period is 6 rupees. So simply, you have something called 1,200. Now this is the value, right? This is the value. This is the value that you are going to accept per bond if you reject this conversion option, right? But if you are going for a conversion option, now this is the value of you. One bond would be shared for 200 ordinary shares, and at the end of the maturity period, the value of the share is 6. So accordingly, it is 1,200. What do you think? Which is more benefit for the investor? 1,000 or 1,200? 1,200 because he is getting the ownership of the company as well, right? So simply the redemption price or the conversion value. So simply we want to take the higher of these two. So here you have the 1,000 and here you have the 1,200. Simply we are taking the highest value among these two, right? Highest value among these two. Accordingly, what happens? When it comes to this our third line, here we are going to write the conversion without redemption because now the investor is going for conversion. Right. So the cash flow equals to 1,200, not 1,000. This is the only part that you have to consider. Clear? Right. The market value coupon and the conversion has been given. Then let's calculate the annuity factors and the present values. Right. What is the discount rate that we are going to use? Last week we used 10% and 5%. So 10%, and here we take it as 5%. So here it's 1,070.59. Here again it's 1,070.59. Right? Then what is the annuity factor when the discount rate is 10% for 5-year period? Annuity factor, I think we have taken it in our last week discussion. How much is it? 3.79. 3.79. Okay. And discount factor? 0.62. Okay. 0.62. Okay, good. Right. So here, what is the value? $84 into 3.79. Yes. 84 into 3.79. 84 into 3.79. 300.36. Okay, good. For this, 1,200 multiplied by 0.62. 1,200 multiplied by 0.62. 744. Okay. Yes. What is the NPV? NPV is how much? Online students, you all are with us, isn't it? Online students.
Yes, sir.
What's the NPV? Are you getting a negative NPV or a positive NPV here? Now, negative. Good. How much is it? 8.25 minus 8.23. Right. 8.23 minus figure. And here, what is the annuity factor? Yes, here, what is the annuity factor? 4.3. Here, discount factor? 0.78. Right. Here, 84 into 4.3. 84 into 4.3. 300. 362.83. 8. So here 1,200 into 0.78. 936. It looks like positive. Right? How much is it? 223.29. 28 point. 228.29. Okay, fine. Right. So what about the IRR? IRR equals what? IRR equals to your lower NP, your lower discount factor plus NPV at lower discount rate, NPV at lower discount rate divided by NPV at lower discount rate minus NPV at higher discount rate. NPV at higher discount rate multiplied by higher discount rate minus lower discount rate. What is your IRR? 8.8. 9.8. So IRR equals to 9.8. Here we are concluding, right? So since IRR equals to cost of debt after tax, right? Cost of fund after tax basis, it's equals to 9.8%. Is the answer. 9.8%. Is online students, is the board visible? Can you all see the values exactly?
Yes, sir.
Right. Yes. Okay. Here. Right? Is this clear for all of you? And please bring calculators up. Sometimes when you do the things using mobile phones, you may get confused. Huh? You may get confused. That is why we call it as a mobile phone. And that's why we call that the particular instrument as calculator. That is why you have two words. You can do, you can do. Right? Okay, fine, clear? Convertible bonds. Right? Convertible. That is how the English comes. Conversion, convertible. Right? It does not say converted, convertible. Now students may have issues with that because simply you need to understand that convertible. There's a possibility of converting your bonds into shares. Possibility word, right? So the possibility word comes as convertible, right? Okay. So is this clear? Fine. All right, students, are you okay with this, Pooja?
Yes, sir.
Is this right? Okay, so that's the end of cost of bonds, right? Simply you know how to calculate the cost of a bond if it is issued at par value. Just recap your knowledge. Yeah? Coupon amount you are going to divide by book value or the issue price or the market value of the bond. Then bond issued at a discounted rate, right? Then for redeemed at a redemption value, higher value. You know how to calculate it in the IRR formula. Then redeemable debentures, irredeemable bonds. Then finally convertible bonds. Right? So these are the things that you know up to now. When you look at the compulsory questions, these things are coming in a bulk for you to provide the answers. All right. Okay. So question number 3 is okay. So now we are going to look at. So let's look at the theoretical part of this. Right. So here you could see the convertible debentures. It says this is where the debenture holder is given the option. Right. This is what we have done. Huh? I haven't discussed any kind of a theory, just explain the practical aspects and we did the question. Then now this is the theoretical part. This is where the debenture holder or a bond holder is given the option to convert the bonds into shares at the time of redemption instead of accepting the cash payment. Right? Rather than taking the 1,000 rupees as the debenture value, he has the option to convert his bond holding into equity holding. That is what it says. So here it says the cost of a bond would be equal to IRR. You know it. However, the calculation will consider the higher of the redemption value or the conversion value. You need to consider about the higher of these two, whether the redemption value or the conversion value. Clear? Okay. That's it. Right. So now we are moving to cost of preference shares. India, we are going to calculate cost of irredeemable preference shares, right? Cost of irredeemable preference shares. It's very easy. Right now, you could see here simply preference dividend divided by issue price of what? Okay. Very simple. Preference dividend. Do you need these formulas for explanation? Do you need these formulas? Okay. Right? Preference dividend divided by what? Issue price. Now I can remember, I believe that you also could do the same, isn't it? Right? Preference dividend divided by price of the share. This is how you calculate the irredeemable preference share. Irredeemable means what again? Irredeemable means what? Do you have a maturity period? No, you don't have a maturity period. Then simply the preference shareholder will be receiving only what? Preference dividend till perpetuity. So we need to divide it by the cost of preference shares. Sorry, value of the preference share and you are going to get the cost. Now, simply this valuation and the cost of capital are reciprocals, right? Simply reciprocals. Okay, so let's look at this question number. Right, question number 4. Question number 4. Right, so here it says Dialog PLC issues simply, again and again, I'm saying for you to calculate the value of any financial instrument, for you to calculate the cost of any financial instruments, you need to have a thorough understanding about features of that particular financial instruments. When you are going to value or calculate the cost of a debenture or a bond, definitely you need to know what is face value, coupon rate, maturity period, maturity value, market value, interest rate, or simply cost of bonds. So you need to have a clear idea about how to differentiate one component from others. Otherwise, it's difficult, right? If you know the difference exactly, it's nothing. It's nothing. Right now, when it's come to the preference shares as well, you are having the particular value, face value is there, and the preference dividend amount. That's the only thing that you have. Right? Is that okay if I erase this? Fine. Right. Okay. So simply cost of a irredeemable preference share KB is equals to preference dividend divided by price of the preference share. Now here it says Dialog PLC issues 5% irredeemable preference shares with a face value of how much? 1,000. That is the particular statement. Now, what are the features that you can identify here with related to preference shares? 5% means what? Bondholders, they are getting coupons or interest. The technical word is coupon. Preference shareholders are getting what? Dividends. Accordingly, preference shareholders are getting dividends and their base is preference. We call that dividends as preference dividends, right? So according to this question, preference dividend as a percentage is equals to 5%, right? 5%. Right. Then what happens? 1,000 means what? The face value, right? 1,000 means the face value. But the issue price is 950. Issue price is 950. Even though the face value says 1,000, you have to pay 950 and purchase the preference share. What is the amount that Dialog pays for its preference shares? So simply they're asking what is the amount that Dialog pays for their preference shares? Simply they're asking the cost of preference shares. Okay. That is the first question. Clear? So now this is how you calculate the cost of a irredeemable preference shares. Now, if you look at this question, can you see the maturity period related to this particular preference share? No. So simply, this is the equation that you have to use. So accordingly, preference dividend amount is equals to face value is 1,000. Out of 1,000, it's 5% divided by issue price of the preference share. You can easily get the answer as how much? As how much? Zero point zero four. 0.05, right? 0.05. Is it exactly 0.05? Huh? Then how much? 5.26, no? Right, so that is why it can't be 5, huh? It can't be 5. So simply, you want to get the percentage, it's 5.26, right? 5.26. If you divide it by the face value, definitely you are getting what? How much? 5%. But here, the face value is 1000, but you are issuing it as 950. Right? 950. It's 5.26. Clear? Yes, online students, are you okay with this? Online students, are you okay with this?
Yes,
Yes,
sir.
sir.
Diane, are you there? Diane?
Yes, sir.
Janaka, are you there?
Hi, sir.
Janaka?
Good morning. Yes, sir.
Hi, hi. Good morning. Good morning. Good morning. Just ask. Okay, fine. Right. Okay, so now you know how to calculate the cost of irredeemable preference shares, right? But here we are not going to calculate the cost of redeemable preference shares, right? Look at this up. We are not going to calculate the cost of redeemable preference shares. It's simply based on the trial and error approach. Do you know trial and error approach? Right? Now, shall I list this? No need to erase actually. Now, let's say redeemable preference shares means what? Redeemable means what? You have a maturity period. After that maturity period, you are going to get your invested amount. Until such time, you are going to get what? Your preference dividend. Right? Until such time, you are going to get your preference dividend. Now, for an example, let's say your face value is 1,000 rupees and the preference dividend as a percentage, it's 10%. Number of period is 3 years. If face value is given, preference dividend is amount is given, number of period is also given. And let's say the current market value or the issue price of this dividend is equals to 850. 850. Face value is given, preference dividend is given, number of period is given, market value is given. So you know how to calculate the value of the financial instruments. Present value of what? Future cash flows. Now simply, here the present value is how much? 850, right? Present value is 850 equals year 1, you are getting a certain cash flow. Year 2, you are getting a certain cash flow. Year 3 also you are getting a certain cash flow. Right? So what are your cash flows? Year 1, you are getting how much? You are getting the dividend exactly correct. It's how much? 100. 1,000 into 10%, you are getting 100. Here also you are getting 100. Here you are getting 100 plus what? The value that you have invested to the company, that is equals to, sorry, it's 1,000. Basically, you are getting the 1,000 face value at the end of the maturity period. Then what you have to do? Now this is the value that you have to get now. Simply, this is the value that we have to get, 850, that is the present value of this particular preference share. How we arrive this in a very simple way by discounting our future cash flows. So these are your future cash flows and we have to discount. 1 plus KP, 1 plus KP, one plus KB to the power 3. Here, this is how you formulate the answer for this question. Is this clear? Now we have to calculate what? This. We have to calculate this. Can you calculate? You were trying to calculate that one. Yes, done. Yeah. Yes, online students, any answer for this question? Yes, online students, any answer for this question? Yes, Dayan, any answer for that?
No, so still calculating.
If you directly type the entire formula in that advanced scientific calculation, definitely you get the answer. Definitely you get the answer. Yes, any answer? Yes, any answer? Yes. 3.9. No.
No, sorry. 11.7, around 12%.
No. Can I give this question to your neighbor? For your name, it's 2 marks. For this question, it's 98 marks. And I'm taking some advanced calculators and I'll give the normal calculators, still scientific calculators. Ready? Now simply, right? Now simply, that's why I told you there are options, right? Simply, that's why I told you, trial and error. Trial and error. What do you mean by that word? Now you need to simply understand the words when it comes to the counting and finance. Those words are really matter, right? Trial and error. Do an experiment. Could be wrong. Again, do that experiment. Could be wrong. Again, do the experiment. Could be wrong. Again, do the experiment. Might be right. Might be correct. Right? So simply what you need to do, you need to take the particular interest rate at a one time and discount all your cash flows from that interest rate and check whether the answer is 850. Right? For an example, let's say we are taking 10% as the cost of preferred shares as the discount rate. So we are discounting all our cash flows from that 10% and we are checking whether the value is 850. Would be wrong. We did a trial, but the answer is wrong. Trial and error. Okay. Then again, based on that value, we know when the interest rate is high, value increases. When the interest rate is lower, value increases, and when the interest rate is high, value decreases. We know it. Based on that, you can again try another different interest rate and check the value is 850. That is what we call as trial and error. Right? Trial and error method. Right? So you don't have that much of a time here when it comes to the examination and all. Right. So simply, the cost of preference shares, right? Cost of preference shares is equals to the dividend of the preference shares plus redemption value of the preference shares minus issue price, or we call it as net proceeds, right? Net proceeds or issue price or whatever, divided by number of periods, right? Divided by the number of periods, right? Dividend per preference share plus the difference between the redemption value and the net proceeds or the issue price divided by the number of periods. The entire formula, right? You are going to divide it by simply the redemption value of the preference share plus the net proceeds divided by 2. Okay. So you can get the value. Do you want to get this equation to extend it? Or no? I can because they are quite confused that you could go through the same. Just assign values. Right now, your DP means what? Dividends per preference share. How much is it? How much is it? 1000 into 10%. How much? It's 100. So our DP is equals to 100. Right? DP is equals to 100. DP equals to 100 plus redemption value is how much? Redemption value here it's silent. Accordingly, you have to assume that redemption is 1000. Right? Redemption value is 1000, and the net proceeds, simply the amount that you are going to get to the company, issue price is how much? 850. Right? 850 divide by the number of periods. It's 3. Right? Divide by number of periods is 3. And the entire formula, you are going to divide it by again the same thing, same thing. Only the operation is different. 1000 plus 850, you are going to divide it by 2. What is the answer? Entire one, 0. Simply, once you get the percentage, it's 16 point. The entire one. Okay, so yeah, it's like this. Simply 16.21. The other digits comes after that. So that is the exact answer. That is the exact answer. Right? This is the exact answer. Online students, is it clear, Budala? Online students. Is this clear?
Yes, sir.
Right. Right, 16.21. Certain digits are coming. That's the percentage. If you exactly apply, right? If you exactly apply that value to here, definitely your answer is 850. Definitely it's 850. Okay, so this is how you calculate the cost of redeemable preference shares. Cost of redeemable preference shares. Right, cost of redeemable preference shares. Right, cost of preference share equals to dividends per preference share plus the big bracket. Inside that you have another bracket. Redemption value of preference share minus the interest, sorry, the issue price of the net proceeds, divide by n. The entire formula you are going to divide by again the redemption plus the net proceeds divide by 2. Is this clear? We are not going to do any tax adjustment here. But when you are doing the calculation for cost of bonds, we did. Right? Cost of bonds before tax, cost of bonds after tax, but here we don't. Why is that? Why is that? Is there any reason? We are not going to do any tax adjustments. Now, if you think about your income statement, right? If you think about your company's income statement, now what are the three cost classifications there? Admin cost, sales and distribution, the other one, finance cost, right? So when it comes to the finance cost, you are debiting interest on bonds. Am I correct? Interest on debentures. Is that correct? So simply, you are adjusting that part before the company is going to pay the corporate taxes. In the income statement, right? So in the income statement, you have the profit before tax, then you have profit after tax. But before that, you charge the interest on bonds. So you know that when it comes to the bonds, they are getting tax shields for tax savings on interest. So that is why we are doing that tax adjustment for the bonds. But when it comes to the preference shares and the equity shares, we are not adjusting the dividends in the income statement, but in the changes in equity statement. Right? After the preference dividend and equity dividends are usually paid after the corporate tax have been paid. Accordingly, we are not doing any tax adjustment for the preference shares as well as for the equity shares. Right? For the debentures, we do because we are getting the tax savings, but for preference shares as well as for equity shares, we are not going to do the tax adjustment because the dividends will be paid after the corporate tax have been paid. Adjustment needed. Okay. Good. Very simple, isn't it? Very simple. Simple. Right? Right, okay, so is it clear? So that's the end of the cost of preference shares. Now you are experts in calculating cost of bonds, cost of preference shares. Am I correct? Right, so the final part is to calculate the cost of equity shares. Right, the final part is for us to calculate the cost of equity shares. It's very straightforward. Cost of equity share is very straightforward. Okay, so now when it comes to the cost of equity shares part, right? Right, when it comes to this cost of equity shares part, so we will have two things. Right, when it comes to the cost of equity shares, you have two things. You have two things. The first one is cost of internal liquidity, and the other one is cost of external liquidity. Right, cost of internal liquidity as well as cost of external liquidity. What is internal liquidity? Very good. So you are having certain amount of reserves with you. That is your internal liquidity. And we say it involves a cost. Is it correct? What is the cost? Excellent. That's the answer. Internal equity involves a cost. So we call it as opportunity cost. Opportunity cost of what? Opportunity cost of. Usually we assume that reserves could be used for the investment. That is simply the opportunity cost of not paying dividends. Right? The opportunity cost of not paying dividends. But if you keep reserves without doing any investment, that is also could be considered as an opportunity cost if that cost is higher than the dividends. Right? Because we are comparative when it comes to opportunity cost, we are saying it in a comparison basis. Right? Okay, so internal liquidity. So here it says firm may use equity capital internally while retaining their earnings. And external liquidity means if you issue shares to general public, that is external. You are getting funds from external parties. Right? Here it says external liquidity will cost more to the firm than the internal liquidity. Now you know what is internal liquidity, what is external liquidity, and here it says the external liquidity will cost more to the firm than the internal liquidity. Is this correct? Why? Yeah. Because in a very simple way, if you look at let's take say before moving to corporate finance, let's take our home. You have savings. You need to buy a mobile phone, right? Let's say it's 80,000. Our price of the mobile phone is 80,000, and you have 80,000 savings with you, right? So you can use that 80,000 to purchase that phone, right? Don't think about initial cash outflow is high, such things, right? Then the other one, the same mobile phone is there. You don't have anything, right? You don't have any funds with you. Then what you have to do, if you exactly want that phone, either you need to borrow it. But which cost is high? So you are borrowing 80,000. For that you are paying how much? You are paying interest. So usually at the end of the loan period, definitely you are paying more than 80,000. Which cost is high? Yes, borrowing. Borrowing cost is high, isn't it? Borrowing cost is high. Cost of borrowing is high. Right. So simply when it comes to this internal and external liquidity again, internal liquidity is already available within the company. But external liquidity, you have to request, right? Many costs involved when it comes to the equity shares, right? Starting from flotation cost to risk, right? Starting from flotation cost to risk. So that is why we say external liquidity cost is higher than internal liquidity, right? External liquidity cost is higher than internal equity, right? So usually when it's come to the cost of equity calculation, here I have mentioned certain growth rate, supernormal growth as well as zero growth aspects. Now, even though the internal or external equity, we are using this particular equation, normal growth scenario. When it's come to the valuation, I believe that you can remember the normal growth, supernormal growth, and what is the other one? Perpetual, right? The other one is perpetual. Just to remind that part, I have mentioned those elements there. So simply, we calculate the cost of equity based on the first formula, assuming that according to our level, the dividend will be increased at a constant rate in a normal way. Right. So what is the formula? It's very simple, isn't it? Right. Cost of equity is equals to next year dividend divided by price of the share plus the growth rate. Plus the growth rate. Once you look at this particular formula, can you remind another formula related with this? Yes? Can you remember? Huh? Can you remember? Okay, don't remind, please. Right, so this is simply the formula that you use to calculate the cost of equity. Cost of equity equals to next year dividend divided by price of the share plus growth rate. Right, so DIV1 is your expected dividend, G means your expected growth, A means your cost of equity. Right, so we learn these things little by little, not at the very beginning. This is the formula. So shall we do some questions? Right. A. So you are going to get your interval at 10:30. Okay, right. So here it says the current market price. Now again, you need to have a very good understanding about the features of the equity shares. You are getting dividends, price, is there growth rate, sometimes could be given, sometimes may not. Right? Okay. Question number 5. So here it says the current market price of the Nestle PLC is 230. Right? Current market price of the Nestle PLC is it's 230 rupees. 230 rupees. The company expects the dividend to grow at a constant rate of 10%. The company expects the dividend to grow at a constant rate of 10%. The expected dividend per share in the next year is 6.5 rupees. 6.5 rupees. You have to calculate what? Cost of Cost of what? Cost of what? Huh? Cost of equity. Huh? If this is the only financing method that the company is having, then it might be cost of capital. Right? Cost of equity equals to cost of capital. If that is, this is the only financing method. Huh? Right. So simply you have to calculate the shareholders' required rate of return. That is simply the cost of equity. You have to calculate this. Okay. Very simple. Right. Cost of equity is equals to your next year dividend. It's given 6.5 divided by the price of the share plus the growth rate. It's 10%. Then the cost of equity equals to how much? 0.28%, simply 28%. 28%. Okay. %. So we have to multiply it by 100. Even though in the examination, it could keep it as a decimal doesn't matter. If you give the marks, but you need to know that it comes like a percentage. Comes like a percentage. Okay. Is it 12.8? 12. Right. Okay. 12.8%. Right. Okay, let's say you mentioned there 28%. Now examination, ultimately examination. We are learning for life, isn't it? We have to learn for life, but anyway, in the process of learning for life, we have certain, components, examinations. Let's say instead of writing here, you have mentioned 28%. The exact answer is 12.8, but you have written 28%. What do you think about the marking? If you look at the nice marking scheme for the business finance, what do you think? Are you getting marks? Are you getting marks? What do you think? Right. So instead of online students, please also consider this matter. I will explain this part at the end. But here, yeah, let's say this is the answer, but this answer is wrong. The correct answer is 12.8%. Now, you did all these things correctly, but unfortunately, you mentioned 28%. Are you going to get marks? Yes. And the formula? Zero. Zero. You don't get any marks. Don't worry, just joking, I'm just joking. Simply what happens, this is your approach. If the approach is correct, you are getting a certain marks for that. But the approach must be correct, huh? Approach must be correct. Otherwise, you can write any nonsense here and get whatever the answer, right? So, if the approach is correct, you are getting and the assignments of the values. If you apply 10% to price of the share and growth rate is 6.5, you are not getting that. So say the approach. I believe that you know the meaning of the approach. Right? And here, unfortunately, you have written 28% instead of 12.8. So if I am giving 1 mark for this, you are getting here around 0.5. Okay. Right. So if the entire mark for this question is 3, example, for the correct approach, you are getting 2. If the answer is correct, you are getting 1. 2 plus 1 equals 3. But if the answer is wrong, but the approach is correct, you are getting the marks for the approach, but here half a mark from the assigned marks for the correct answer. Okay. Fine. Okay, so now what is the correct answer? Right. So this is the correct answer. 12.8% is the correct answer. 12.8 is the correct answer. Okay, right? Yes, online students, are you clear with this? Yes, online students, Pudala, are you clear with this?
Yes, sir.
Okay. Right. So we'll move to next question now. Right. So here it says what? Listen now. The share of the Sampath Bank, right? The share of the Sampath Bank is currently selling for, right? The share of the Sampath Bank is currently selling for 153, right? 153 rupees. Okay. 153 rupees. It wants to finance its capital expenditure, right? It wants to finance its capital expenditure of 100 million either by retained earnings or issuing new shares. It's a story, right? It's a story. If the company sells new shares, the issue price will be 145. The dividend per share is 5.5 rupees and the growth rate is 6%. So you have to calculate the cost of internal equity as well as cost of external equity. Internal equity as well as cost of external equity. So you can use the same formula, right? Same formula to calculate this. Right. So here it says current market price of the share is 153. Then they can either go for a retained earnings or selling new shares. If the company sells new shares, the issue price, right? The issue price of the share will be 145. 145. The dividend per share in the next year, right? The dividend per share in the next year is 5.5 and the growth rate is 6%. Growth rate is 6%. Now this is the summary of that particular question. So you have to calculate what? You have to calculate cost of internal equity as well as cost of external equity. Internal equity as well as external equity. How to calculate? Just give it a try. Forget the same one. Unless otherwise says the critical of the retail earnings. Yeah, just give it a try. Yeah, just give it a try. You have to think, right? Thinking part is there. Right, so here you have something called internal liquidity, right? Cost of internal liquidity, and here you have cost of external equity, cost of internal equity, and on the other hand, cost of external equity. So this is the formula that we are using, right? Okay. We'll start with the cost of external equity, right? Now, next year dividends per share is how much? 5.5. Yeah, it's 5.5. Growth rate is how much? 6%. Right. Here, cost of equity equals to your next year dividend is 5.5 and the growth rate is 6%. Right? So dividend will be increased at a rate of 6%. Okay. Dividend will increase at a rate of 6%. Is that clear? Fine. Okay, good. Now, this is the first part of this equation. Now, here what we want to do, we want to incorporate the price. Right? We want to incorporate the price. So, which price Puta, we are going to take here? If it is a cost of external liquidity, which price we are going to look at? That's the thinking part. Huh? This is actually a simple question, but the logic is there. That's why I written this particular question. Right. Which price? Hands up those who say issue price. Hands up those who say market price. Online students, what do you think, Puta? Janaka, what do you think?
Sir, I think for the internal equity, mostly we can consider issue price. For the external, we can consider market price.
Okay, for the external, we can consider the market price. Now here, in a very simple way, right? Simple way, when you are going to issue shares, that's the word. When you are, let's say, Sampath Bank is issuing shares. And for that, they believe that they are going to pay a dividend of 5.5 per share. And here you need to take which price? Issue price. Because it's external liquidity, you are going to issue shares. Therefore, you need to have which price? Issue price, right? You need to have issue price. So the issue price is how much? It's 145. Issue price is 145. Now, when it comes to the internal liquidity, what happens? You don't have issue price. Am I correct? You don't have issue price. But for the company share, there will be a market price. Based on the performance and the current state of the company, the market is reacting. Right? The market is reacting. Accordingly, you have a market price for the current state of the company. So accordingly, the market price of the share is 153. Get the logic? Why we are taking issue price for the external equity? Why we are taking market price? According to the question, according to the question and the given information. Why we are taking market price for the retained earnings? Because for an example, let's say, don't consider about the minor shareholders. Let's consider about major shareholders. So simply you are having a lot of shareholding within the company. So simply, Puta, you are analyzing what company does. Am I correct? Simply you are analyzing what about the prospects of the company, what about the future aspects, what is their profit, how they calculate it, what about the amortization, everything you consider. If you are a major shareholder, plus if you are an expert in finance and accounting, then based on that, you react in the market, right? If a company is having this much of a retained earnings without doing any investment without doing any investment, and they are planning to do investment, accordingly you react in the market. So that market price must come here. Yeah, right. So accordingly, your cost of equity is how much? Here it's how much? 9.5. For this? Sorry? 9.79%. Which is higher? This side to that side. Huh? Cost of external equity is higher than cost of internal equity. Right? Cost of external equity is higher than cost of internal equity. Can you remember? The same statement I told earlier as well. Cost of external equity is higher than cost of internal equity. Yes, sir. Yes, sir. Janak, is this clear for that? Janak?
Yes, sir, it's clear now.
Okay, fine. What about other students, online students? Yes. Is this clear for all of you?
Yes, sir.
Is this clear for? Okay, fine. Good. Okay, fine. Very good questions. Good. Right, is it clear? Very good questions, huh? I'm really happy. I'm really happy. Right. Right. Question number 6 also done. And now we have to go with question number 7. Right? Different types of questions are. You need to know the basic. Based on that basic, you have to apply your accounting and finance knowledge to sort out the answer questions. To sort out the questions. Right. Okay. Let's look at question number 7. Question number 7 now. Question number, please try question number 7. Little by little. Yeah, question number 7. No, question number, sorry, 7. Yes. Question number 7. For me? End of next month. End of next month. In July. In July. End of next month. Of next month. Go to the beginning of August. End of next month. End of next month where you exams. It's initially July 9, you are going to say, economic business finance, and but you have the lecture series till 15, if I'm not mistaken. And that's the end of my hearing if you want. I may be available for the research third year, but it's a compulsory subject to research. Maybe, but like to be a chance. Okay, I come to know. Right, okay, yeah, please try this question. Please try this question. So, yeah, after this question, you are going to have your break. What does it say? Current earnings of Canary Cables PLC are 1 million. And the company's share is selling at a market price of 120. 120. The company has 220,000 shares outstanding and has no debt. The earnings of the company expected to remain stable. These words are very important. Remain stable, no debt. And it has a payout ratio of 100%. Payout ratio of 100%. Payout means the dividend percentage. Liquidity ratio is coming under the working capital now. Quick asset, quick ratio. How you calculate the immediate liquidity of the company? How you calculate the immediate liquidity? You have asset is there, current ratio is there. How you calculate the immediate liquidity of the company? Immediate liquidity, yeah, immediate. Huh? Yes, okay, we will discuss this that one. You can discuss that one under FR. Right, okay, yeah, so what does it says? In this question, it says current earnings, right? Current earnings of the Kennedy Cables PLC, it's 1 billion. Then, the say market price of the company share, it's equals to 120 rupees. Number of shares of the company equals to 20,000. And you don't have debt. Please underline it. Please underline it. Then earnings of the company are expected to remain stable. And the payout ratio is simply 100%. So what does it mean? Your payout ratio 100% means what? You pay exactly what you earn. If you earn 1 rupee, you pay that 1 rupee as dividends. That's the meaning of it, right? Okay, first question is you have to calculate the cost of equity. You have to calculate cost of equity. How to calculate it? Hmm? Yes, good. Good. So when you're answering to these type of questions, first you need to know what you have to calculate. Right? These are the steps. Even if also you may follow the same step. You have to calculate cost of equity. So how you calculate your cost of equity? Cost of equity equals to next year dividend divided by price of the share plus the growth rate. This is how you calculate it. So simply, if you assign the relative values for these variables, definitely you are going to get the answer. Right? Definitely you are going to get the answer. Now, do you know the next year dividend? Based on the given information, you could, but for the moment, do you know? No, you don't know, right? You don't know. Do you know the price? All of you, please look here. Do you know the price? Is it given? Yes, you know the price, it's given. Do you know the growth rate? Would be calculated, but at glance, can you identify? You can't, right? So simply, to get the cost of equity, you need to have the values for 3 variables, but out of those 3, you don't know 2. So you need to calculate it first. That is how, as you correctly mentioned, Pudha, that dividend part comes. First, you need to calculate the dividend per share, right? Then growth, then you can get the answer, right? Assign the values. If it has not been given, then you need to have that creative as well as analytical mindset to calculate that given value. Right? That's the issue. Okay, so dividends. Just a minute. Right. Okay. So how do you calculate your next year dividend? How do you calculate your next year dividend? Yeah, I think you can use next year dividend. Dividend per share. Okay, good. Right. Okay, we'll see. Good attempt. We'll see. Right. Now, here directly, you have not been given dividends, but the company has given you the earnings and the number of shares. From that, you can calculate what? Earnings have been given and you have been given number of shares. Then what is the answer? What is the probable answer? If you consider these two, what would be the probable answer? You can get something called E. P. S. Right? You can calculate something called earnings per share. Right? You can calculate something called earnings per share. Right? Earnings per share. So your earnings are 1 million. Right? 1 million. And the number of shares, it's 20,000. Accordingly, your earnings per share equals to how much? It's your earnings per share equals to 50, right? Your earnings per share equals to 50. Right, good. You have calculated your EPS. It's 50. Then how you come to dividends from EPS? So simply, how you come to your dividends from earnings? The company, very good. The company has 100% payout, which means they pay whatever the amount that they earn. So simply, according to this question, Buddha, their total earnings, right? Their total earnings are equals to dividends, right? Their total earnings are equals to dividends. Accordingly, their earnings per share is also equals to dividend per share or the dividends. Clear? Good. Then we can replace the CPS as dividends. Am I correct? We can replace this earnings per share as dividend per share because of this particular assumption. But here it says next year dividends, not this year dividends. What to do? Very good. In this question, it says earnings remain stable, which means that is a particular assumption. Practical terms could be varied. So since the earnings remain stable, your this year EPS equals to this year EPS as well as next year EPS because of that reason. Very good. So it's 50. Market price per share is equals to 120. Growth rate. You must have a growth rate, isn't it? Why? Huh? Why? So here how you you need to have your growth, isn't it? How you calculate your growth? I'm learning from the beginning, assuming that certain levels, How you calculate the growth? Growth, your retention ratio multiplied by last week lesson. Your retention ratio multiplied by return on equity. Am I correct? This is how you calculate your growth, right? Retention ratio multiplied by growth, sorry, return on equity. Can you all remember this? Just take a look at your previous lecture notes. Yes. Again, follow growth rate equals to retention ratio multiplied by return on equity. Yes, just look at. Yeah, valuation picture will be there. So in other words, you could have remembered it. Actually, sorry. Actually, so that's in your valuation material, right? You could see something called growth. Right. Okay. So in here, bar, you can see, right? Growth equals to retention ratio multiplied by return on equity. Okay. Right. Retention ratio multiplied by return on equity. But in this question, your payout is 100. Okay. So meaning that you don't have any retained earnings. Am I correct? You don't have any retained earnings. So either you may have 100% ROE, whatever, the final answer is 0. I can just put 0 there, but you need to know why it has become 0. Right? So simply, you don't have a growth rate. Right? Now what you have to do, you have to write the same thing and write it like this. Because once you look at these documents at the end of this year or this month or the next month, you might wonder that what happens here. Yes.
So multiply by 100. So that also the formula for the growth rate. If you took that formula,
The difference between the current year dividend and the next year dividend.
we do have those 50-50. So the difference is 0 and
Is it given?
Huh?
Is it given?
no. So in the calculator, the 50 is current year. So
50 is your current year dividend.
they also will be the same.
Yes.
So no difference.
No. No.
We have mentioned this.
Yes. Just a moment. Because the same amount you are paying in the next year. Uda, same amount. Uda. In this year, you are paying 50. Next year also 50. In a way you are paying, but the same.
Yeah.
Yeah.
Not understood. The difference is 0.
Yes. Okay. Yes, because the assumption is, according to this question, it says they are paying all earnings as dividends. So you don't have retained earnings. And this is how you calculate the growth. According to this formula, you don't have a growth. Right? So the final answer is what? Cost of equity equals to how much? 50 divided by 120. Yes, 50 divided by 120. How much? 41.6%. Right, good. 41.6%. Right. Is this clear? Yes, online students, are you okay with this, Puna? Your final answer is 41.6. Is this clear for all of you?
Yes, sir.
Right, now this is why, right, this is why right, this is why you can see here, if there is a 0 growth, this is the formula, right? If there is a 0 growth, this is the formula, right? Next year dividend divide by price of the share, and we have taken that one into consideration. You don't have a growth. So here I just mentioned plus zero for your understanding, yeah? Right? So this is the formula for equity equals to next year dividend divided by price. Okay. Right. So the final part of this question before interval. Right, so there's a second part as well, isn't it? So I said we are completing this one and having the interval, isn't it? Did I? It's completed. Yeah, okay. Shall we complete the entire tutorial and have it? Right, okay. Second part of this question. If the company payout ratio is assumed to be 70%, and that it earns 20% rate of return on its investment opportunities, what would be the company's cost of equity? So it's easier. So this is the first part of this particular question number 7. And this could be the second part. If the company's payout ratio is 70%, right? 70%, and it earns 20% rate of return on its investments, what would be the cost of equity? Right, so please give a try, online students. Yes, okay, done. Right. Okay. Online students, what is the answer to that? Online students? Yes, online students, what is the answer?
47.6.
Online students? Sorry,
47.6.
47.6. Okay, so we'll see, yeah. We'll see. Now, here it says, right? Look at this, here it says your payout ratio is 70%, which means whatever the amount that you earn, you pay 70% as payout, right? You pay 70% as payout. So you earn 50 rupees. Earlier, our earnings and dividends are same, but now it's different because you have a different payout ratio. So 50 1 minus your retention ratio simply 30, that is your dividend, right? Right. 50 1 minus B means your payout ratio simply 70% is there. Then price of the share is 120 plus growth. How you calculate the growth? Your retention ratio is 30% because you are paying 70% as dividends. Accordingly, your retention ratio is 30%. Then your ROE is how much? 20%. Your ROE is 20%. Is this clear? Right. So then you have your cost of equity. Cost of equity equals to how much? 40. How much? 11.7. Yes, how much? 30 point. 35 point. 35.16. Okay. So cost of equity is equals to 35.16%. Right? 35.16%. Clear? Right? So if we rewrite this formula, it is simply of the earnings per share minus 1 minus retention ratio divided by price of the share plus retention ratio multiplied by R. So this formula is there in your slide. Right? This formula is there in your slide. Is this clear, online students? Is the value clear? How we arrive at this value?
Yes, sir.
Right. So this is the formula that we have used. It's very simple. Right. So you could see it here. Right. Right. So this is the formula. Right. This is the formula that we have used. Very simple. Right. Earnings. You are removing the retention part, taking the payout, dividing by the price plus the growth. This is the formula. Okay. Right. So that's simply the end of cost of equity based on dividend valuation approach. So you can have a break for 20 minutes. So please come here sharp at 11:05. I'll give you your next interval sharp at 12:15. Okay. Yes, online we are going to have a leave, but not a leave, but interval. Yeah, so please be there around 11 o'clock. 11:05. Okay, thank you. Right, yes, dear students, online students, are you available? Online students, are you available?
Yes, sir.
Right, so what are the updates? What are the updates? Yes, Sena, any update from you? How was the week? How was the weeks with you all?
Good, sir. Going on.
Okay. Yes, other one, how about you? Other one? Yes, Diana, any update? Danagal, yes, Chandrakant, finance. Okay, shall we start?
Excuse me, sir.
Yes, yeah.
Sir, would you mind just tell us how to do this group activity? How to, what is the report should be, the formatting, and how to insert the group detail? Any common structure is there, sir?
Sure, sure. When it's come to you're saying the uploaded activity or the group assignment.
The uploaded one, sir.
Okay, so I'll provide the goal. Now today one of there is my sub objective to provide understanding about your group activity as well as the group assignment. I haven't uploaded yet, but I will upload it. I have prepared all the things, just a matter of finalizing the number of groups. So anyway, today I will explain at the end both how you need to approach everything from the beginning to end.
Thank you, sir.
Right, shall we start? Okay, fine. Right. So now, if I put it very simple way, you are experts, right? You are experts in calculating the required rate of returns that are expected by the shareholders or investors in terms of bonds, preference shares, as well as equity shares, right? According to your level, right? According to your level, you know how to calculate the cost of bonds, right? You have cost of bonds issued at par, issued at discount and redeemed at a premium, right? Redeemable, irredeemable debentures, convertible bonds. You know how to calculate the cost of all of these things. Then when it comes to the preference shares, you want to know how to calculate the cost of redeemable as well as irredeemable preference shares. Then when it comes to the cost of equity, you got to know how to calculate the cost of external equity as well as how to calculate the cost of internal equity using dividends and EPS models. Okay, right. Now, there is only one thing that you have to learn when it comes to the cost of equity part. Right, one thing that you have to learn when it comes to the cost of equity. Now, this dividend approach may have certain issues. Now, hope you remember that I told you when we were doing this valuation part, when you have different approaches to calculate something, which means all the models may have certain issues. That is why you have one model over another. Right. Similarly, when it comes to this cost of equity calculation, dividend approach may have certain issues. Sometimes you cannot apply this to the entire firms. The growth rate could be different. You have different approaches to calculate the growth, and we are assuming that dividend will grow at a perpetual rate. So those are some assumptions which may not seem in the practical, right? But little bit of practicality is also there. So accordingly, we have another model called capital assets pricing model. Right? We have another model called capital asset pricing model, and actually this is also a little bit outdated nowadays, but this is the fundamental. Right? When it comes to the capital asset pricing model, this is one of the model that we used previously. And now we have another different factor models, 2-factor, 3-factor, 4-factor models, which have been developed based on this model. That is why this model is important. Right? That is why this model is important. Now it's very simple. When it comes to this capital assets pricing equation, this is very simple. Now, if you look at the formula, you can understand how simple is that. Right? It's just a simple equation, and you need to know the values for those equation. Usually it is given, and sometimes you have to calculate it, but that calculation is not that much difficult like the calculations that we have attempted. Right. Now, here what happens is, right? So here we are saying your required rate of return, right? Your required rate of return or cost of equity. Some says this is as expected return, but I'm not going to do any kind of a comment for that. Some says this is expected return. Right? Some says these are expected returns, but okay. So simply it's required rate of return or the cost of equity. Right. Now, in here, what we say is, if you are an investor of the company, you first look at what is the risk-free rate. Right? Before, hope you remember that at the very beginning of our cost of capital lesson, I explained that particular graph. First, we are starting with risk-free securities, then cost of bonds, then preferred shares, then equity shares. Right? You always compare with the government. Right? So you know that government without bearing simply, right? If when it comes to the government securities, without bearing any kind of a risk, you are entitled to get a return. Right? Without bearing any kind of a risk, you are entitled to get a return. Right? So that return is known as what? Risk-free rate. Right? That return is known as risk-free rate. So without investing in government securities, and if you go to invest in a private company securities, at least you expect this. Clear? That is our assumption. At least you expect this. Right? I haven't put my hard-earned money into treasury bonds, but I am now going to invest in ABC companies shares. If I have invested in government bonds, I may have received 11%, but now I may not, because it's the private company. But I need at least this much. Okay? I need at least this much. If that is the case, your required rate of return is equals to risk-free rate. Okay? Risk-free rate. But when you are moving to the private sector and the risky areas, you have to face something called risk. Right? You have to face something called risk. So that risk in here, we consider it as the systematic risk. Right? I will explain what is systematic risk later. So simply understand this is your risk. Risk is being measured by the particular symbol called beta. Right? This is the symbol for the beta. Right? Beta estimates the systematic risk of the company relative to the market risk. Right? Then what happens in the market? The market may generate the return to you, but you need to consider how much that return is higher than your risk-free rate. Right? How much that return is higher than your risk-free rate. So you need to think about it. Right? Okay. So then, once you are going to invest in private companies, This is how you get the minimum required rate of return. Minimum required rate of return. Right? So without this, right? For an example, again I'm saying, you may have the chance to invest in government securities. Let's say treasury bonds. But you are not going to invest in treasury bonds, rather than you are going to invest in private companies. Okay, so accordingly, the return that the treasury bonds may give to you, you have to forget it. Right? But at least you need that much. Then the return that you expect from the company is equals to the risk-free rate. Right? That is the minimum return that you're expecting. Why? If I haven't invested in your company, I may entitled to get a risk-free return. Right? So without investing that, by taking the risk, I have come to your company for the investment. So please at least provide me the risk-free return. That's the simple logic. Okay. But when it comes to the private aspects, what happened? You are entitled or you are exposed to a risk. Right? So that risk is being measured by the term called beta. Right? So simply that is a systematic risk. Systematic risk. Then you have to adjust that systematic risk with the difference between market return and risk-free rate. Market return and risk-free rate. So simply we call this as risk premium. Right? We call this as risk premium. Risk premium. Why premium? Because you are bearing a risk. For that risk, you need a premium. Okay. So then this is the formula that we use to calculate the cost of equity or the required rate of return under the capital assets pricing model. Okay. So this was developed earlier in 1974, if I'm not mistaken, I was not there. Right. So here the simple assumption is the return or the cost is depend upon the risk. That is the base of this particular equation, right? The return depends on risk. The risk is the only factor which determines what? Huh? The return. The return. Based on that assumption, this particular model has developed. You know, when it's come to this particular equation, y equals c plus mx. So here this is the y, and here would be c, the constant. The point where the y-axis crosses, and this is the m, the slope of the curve, and these are the other variables. Okay. Don't think that much. Huh? Y equals c plus mx. Okay. So here, yes, this is the variable and this is the coefficient related with. So risk is the only factor which affects the return or the cost of a equity. Based on that principle, this particular model has been developed. And this is a whole model. But nowadays we have some advanced model other than this. But this is the base. So now here we are saying other than the risk, we have to consider about market to book value ratio, company size, even investor sentiment. We are going to measure, and we believe that investor psychology or the sentiment may have impact on the cost or the return of the share. Okay, so those are some advanced model, but this is the first model or the initial model that has been developed. Known model, known model. There could be unknown models, known models. Okay, so it's very simple. You will be given the values. You can calculate the return. Right. So here it says the capital assets pricing model. Capital assets pricing model. Right. Describe the relationship between systematic risk and the required rate of returns for the assets, particularly stocks. CAPM is widely used throughout finance for pricing risky securities and generating required rate of returns for assets, given the risk of those assets and cost of capital. Okay, so forget about question 19 and 20 there. Then that is the formula you have. RF means your risk-free return. BI means your beta. It captures the systematic risk of the company compared to the market risk. Market risk. Usually, when you get market risk equals to how much? Market risk equals to how much? Market risk equals to usually equals to right? So, if it is more than one, it's risky. Less than one, it's low risk. Right? Compared to the market, you might have seen these things. If you go to the Colombo stock market website, and if you just go to a company information, you can see the beta level of each company. Right? Beta level of each company. The risk compared to the market risk. And this is how you draw this particular equation. And please forget about the systematic risk part. Huh? This is what it says. Risk-free rate. We call this as SML means what? Security market line. Right? SML means security market line. It shows the risk and return relationship between stocks. Right? SML means security market line. Right? Security market line. And forget about this systematic risk there. Right? Systematic risk is what? You have different type of risk, isn't it? You may have business risk and finance. Business risk is what? Business risk is what? Exactly. It's related with the nature of the business. Right, for an example, let's say if you consider about one of the telecommunication industry, they may have a business risk. Why? Similar kind of a companies are operated in that particular industry. So what are the things that you do? You are trying to always capitalize your market. Right? You are trying to capitalize your market by getting more market share. That is the business risk. Risk prevailing within the particular industry. Right? Then what is financial risk? Financial risk. Risk that shareholders are undertaking, isn't it? Not being paid at the time of liquidation. Because shareholders, we haven't guaranteed that they are getting a dividend. We haven't guaranteed that they are getting the priority when paying and gain. So that is the risk for them. Right? Financial risk that the shareholders are not being paid at the end of at the liquidation of the company. So that is a different kind of risk. Business risk and the financial risk. Right? So that is how you develop these as a beta and equity beta. Right? Then here it's systematic risk. We have something for systematic, then what could be the other one? Opposite of systematic? Non-systematic. Right? Systematic is there and the opposite is non-systematic. So accordingly we have something called systematic risk as well as non-systematic risk. Okay. Right. Simple question. Can you control the inflation rate? Due to that, you may have changes in the price risk. So that is the price risk. Can you change it? You can't. So the risk that you cannot control by a particular individual is known as what? Systematic risk. Even though you do massive amount of investments, simply even though you have a diversified, I believe that you know the meaning of these, even though you have a diversified portfolios, you cannot control that risk. You cannot control that risk. Accordingly to that, what happens, right? If I draw a graph here, so here you have your risk, and here you have the right, or the number of assets that you have invested. Right. So what we are doing to mitigate the risk, we are investing different securities, isn't it? Right. You are not going to put all the eggs into one basket. That's the logic. You are not going to put all the eggs into one basket. If you choose hospital, then you could choose on the other hand travel and tourism. Likewise, usually be diversified. our investments, right? So that is how we reduce the risk. If the tourism sector doesn't perform during the COVID, hospital sector performs, isn't it? So you are getting losses, but your losses will be lower because the hospital industry performs, right? Then the systematic risk is risk that cannot be controlled by an individual. Risk that cannot be controlled by an individual, even though you have massive investments. Okay. Then what is the other one? Risk is there. The other one is not systematic risk, which means the risk that cannot be that can be controlled by an individual by diversifying your portfolios accordingly. That curve goes like this. Right? So if you have this much of investment, the risk is high. Right? But if you have more and more investment, what happens? Risk will be reduced. So this is your systematic risk and this is your non-systematic risk. Can it go like this? Can it go like this? Can they interchange? Can you can't? Can't, because up to this point it's unsystematic, this point systematic, again unsystematic. Cannot be, no, isn't it? Practical, huh? Right, so this is systematic and unsystematic risk. Right? Okay, online students, are you clear with this?
Yes, sir.
Right? If you have any question, you can ask. Yes, any question you can ask. So what about like systematic risk? Why? You cannot control it. Even though you have very good investments, the identified portfolio. Right? That risk cannot control it. But there are some risks which you can control. There is some systematic risk. When you are having more and more investment, that risk reduces. Example, yes, for example, the same example that I gave for example, let's say, for the moment you have done the investment in hotels, right? So you are in that point, you are in this point, right? Let's say you are in this point, okay? So this is the amount of investment that you have done in the hotel sector, right? But you understood that the return that you are going to get will be lower in the future due to this COVID and all. Then what you do, Buddha, you are searching some other investment opportunities rather than hotels. Then you understood hospital sector is much better rather than hotels. Then what you do, you are going to further do investment in hospital sector. Then your risk comes down. Then any losses that you are going to make in the hotel sector would be rectified up to some extent from the return that you are going to generate from the hospital sector. Very good. Diversified. Right. Okay. We do a question, but let's look at some of the assumptions. Actually, no need. Some of the assumptions coming under this capital asset pricing model. So we believe that the market is perfect. Actually, market is not perfect. Right. So there are inefficiencies are there. Right. The value that you calculate is entirely different from what is the market value, and you have transaction costs. Right, many things are there, but here it has been developed based on perfect capital market assumption. And here also again, they believe that homogeneous expectation, if you look at the final assumption, homogeneous expectation, which means entire people believe about a particular investment in the same way. Right? The risk class is same. In not practical that much. All assets are marketable, right? It's not. Some shares are liquid, but some shares are illiquid, right? So these are some of the assumptions that we have to have this kind of understanding for the assumptions. Right. Okay. So shall we do a question? Right. So we'll move to our next question. What is your question? Right. Okay. Question number 8. Right? Question number 8. Yeah. So here it says the company has an equity beta of 1.4. Right? Here it says the company has a equity beta of 1.45 and the risk-free rate is 8%. Market risk premium is 12%. You have to calculate the required rate of return or the cost of equity. Required rate of return or the cost of equity. The company has an equity beta of 1.45. So which means the beta is equal to how much? This is very simple, huh? 1.45. The risk-free rate is 8%, right? The risk-free rate is 8%, and the equity beta is equity or whatever beta is 1.45, and the risk premium is 12%. Risk premium is 12%. So simply, it's 12%. What do you think about the required rate of return or the cost of equity? Yes, how much is it? Yes. How much is it? 25.4, right? 25.4. Online students, are you okay with this? Online students, are you okay with this? Right. So it's 25.4, isn't it? Now, what is the market return? What? I'm serious. You want the question? Yes, what is the market return? What is the market return? That is most of the equity. Yeah. What is market return? This what is the market return? 20%, no? The market return is 20%. Now here, how you calculate the risk premium? How you calculate the risk premium by getting the difference between the market return and the risk-free rate. But without giving those values, I have directly given you the risk premium. So simply your risk-free rate is 8% and the market return must be 20%. Right? So that's it. That's it. So now you all are masters in calculating the components, cost of capital. You know how to calculate the cost of bonds, cost of preferred shares, cost of equity shares. Okay. I'll give you 2 or 3 minutes. Just go back. Just go back. Online students, please just go back. Now, cost of capital lesson, just look at the things that you have done. Just look at the things that you have done. Just look at it. Now, everything is down. It's up. We find it out. So we are going to do the very. Okay, what do you think now? Now we have how many questions to be discussed? How many questions to be discussed? 9, 10, 11. Only 11 questions, no? Okay, so we have only 3 questions. Okay. We'll take. All these 3 questions are easy. We'll take only 2 difficult questions and we'll do and we'll have a break. Okay, your lunch. Then once you come here after the lunch, help me do that big question to get the hands-on experience. One thing which I have given to you to practice 2 big questions, valuation and cost of capital. Shall we do that cost of capital part? That okay? Because what you said, I felt like that. Okay, shall we do it? Then nearly the rest of the time we can spend to discuss about your assignment from starting to end. Anyway, I'm going to complete at 2:30. Yeah, don't 2:30. Fine. What do you think? Yes, what do you think? What you say, I'll do. You say, I'll do. I would be fine. Yeah, so similar kind of a question, would be from valuation. Right? Okay, so you are going to have your interval. It's past 12. Is that okay? Then please come here sharp at 12:30. Sharp at 12:30. I will discuss that particular question with you by taking 1 hour. Then rest of the hour we can spend to elaborate the sign. Is that okay? Okay, oh, what do you think? Do you want to do that question? Do you want to do that question? Okay, fine, right. So, right, okay. Right, yes, sound students, I believe that you heard the discussion. Right, so now you know what are component cost of capital, cost of equity, cost of preferred shares, cost of debentures are coming under the categories of component cost of capital. But hope you remember that at the very beginning I told you, if the CEO comes and asks you, hello, Mr. Finance, what is the entire cost of our capital? you need to have a particular value there. Clear? That will be given by weighted average cost of capital. Okay, so that weighted average cost of capital will be calculated by considering all these component cost. So now we are going to look at that. But before going to learn the theory behind the WACC, we'll do a question to get an understanding. Right? First, you need to know this is WACC. No? Before learning the theory, you need to look at the practical aspect. Right? Since you all are working, that's what I believe. Right? So you want to know what is the practical aspect, then we'll come back to theory. Is that okay? Right, okay. So let's look at to question number 9. Right, let's look into question number 9. Yes, so here it says, right, so here it says, following details are available for Hades PLC. Now, little by little, we are moving to some big questions. Now, what do you think? Once you, this is not a big question, but little bit, yeah? So once you look at these type of questions, what you need to do first? What you need to do first? Assume that this is your examination question. What you have to do first? Very good. First, you need to read the requirement. What you have to do. So here, what you have to calculate the WACC, weighted average cost of capital, for the company based on book value and market values. Right. So simply you have to calculate something called WACC based on book values and market value. So WACC can be calculated based on book and market value. That is the learning point. Okay, then you can start reading now. Otherwise, what happens? Most of them, it is a simple question. Sometimes in your paper, it will be 2 or 3 pages. So students, what they do mostly, they read the entire story and then come to the required part. Then again they go through the, they have to do this. Again they read it. Time wasted. Okay, right. So we'll start from here. Right. Okay, good. We'll see. Now you are going to calculate, right? You are going to calculate WACC, right? You are going to calculate WACC. And this WACC can be calculated based on book value basis as well as market value basis. Clear? Book value basis as well as market value basis. Right? Now, for you to calculate WACC, you must want to know what your component cost of capital. To calculate your WACC, you want to know your component cost of capital, which means you need to know your cost of equity, you need to know your cost of bonds or debentures, you need to know your cost of preference shares. This is the part. Right? This is the part. You have to calculate WACC. You can do it either by book value or a market value basis. Anyway, for you to calculate WACC, you need to know your component cost of capital, which we have done already. Simply, what is cost of equity, what is cost of bonds, and what is cost of preference shares. Clear? Good. So, in this question, it says, following details have been available for the Hades PLC. Sources of finance have been given. Actually, cost is already given. You don't want to calculate this. All the things have been given, but your examination, you have to calculate. Right? We'll see. Book values and the market values has already been given. Cost of equity is 18%. Reserves 18%. Preference share capital, the cost is 11%, and the cost of debt is, or the bonds, is 8%. Okay, right. Now, We don't want to bother about calculation of these things because cost of equity is given, cost of bond is also given, cost of preference share is also given. Please follow these steps. When you are, I will explain more things when we are doing that particular calculation. Otherwise, first plan, right? Okay. Right. So then, since you have been given these things, right? So first you need to open a particular format or a table. So in that table, you have something called sources of finance, same table, sources of finance, then cost of each financial instruments. Now here we are going to calculate the weighted average cost of capital based on book value, because we have to do it for market value as well. We are going to calculate the WACC based on book value. Then you have book values, right? Book values are there. Then you need to get something called weight. Thereafter, cost of capital. Thereafter, cost of capital. Or if you like, we can combine the other table for this as well. But first we'll go one by one. Let's we'll go one by one. Source of finance, cost, then the book values, weights, and the cost of capital. So here you have your share capital. The cost is 18%. Book value is 450. Right? Then you have reserves and surpluses, retained earnings. It's again 18%. Book value 150. Then preference capital is there. It's 11%. Cost is 11%. And it's 100,000. And finally, you have your debt. After tax cost of debt is 8%. And here is 300,000. 300,000. Okay. Correct, right? Values are okay, no? So tell me the final value of the book value. What about the, the value of your capital structure in terms of book values? How much? Is it something like this? Correct? And so simply, this is your capital structure, right? So this is the book value of your capital structure, right? This is the book value of your capital structure. Then what you have to do, you have to calculate the weight. Weight means what? What about the proportion of each and every sources out of the total capital structure value? How much of, what is the percentage of preference shares? What is the percentage of equity shares? Bonds. Likewise, you have to calculate. That is your weight. Yeah. So please calculate the weight. Weight. 450 divided by 1000 into 100. 150 divided by 1000 into 100. Likewise, weight. Simply the proportion of each and every sources in your capital structure. The percentage of the equity shares, equity values, the percentage of preference share values, the percentage of bonds value, the percentage of retained earnings values. Now, what are the percentages? Yes. Here it's 45. 45%, 15%, it's very easy, isn't it? 10%, 30%. So this must be equals to definitely 100. Right? Definitely 100. Okay. Right. So here you have your cost column. Let us rename it as A. Right. This is your cost column. Right. Let us rename it as A. And here this is your weight column. It is there. Let us rename it as B. Now, what we are going to do is simply we are going to get the product for the multiplication of these two. A, we are going to multiply by B. Simply, we are going to multiply the cost of each financial instrument by its relevant rate. Right? By its relevant rate. So, what about the share capital? Is 18% into 45? 800.
8.1.
8.1%, okay. 8.1%, good. Then here,
2.7.
2.7%, right?
1.1.
1.1%, 3.2%, 2.4%, okay. 2.4%. Simply you need to add all these things together. Right? Simply you need to add all these things together. Yes, what is the answer? 14.3%. What is this? This is your weighted average cost of capital, right? In terms of book values. Now, if you look at your equity, cost of equity is 18%, cost of reserves 18%, cost of preferred shares 11%, cost of bonds 8%. Individual, right? This is something like individual marks for your business finance subject, and this is the average mark for the business finance subject, right? So once a particular person asks you what is the cost of capital of your company in terms of a percentage, you cannot sell each and every component individually. You need to have a one value. This is that one value. So you can say overall it's 14.3. So if anybody knows finance or accounting, mostly finance, they know yes, this is not the exact amount, it's the average amount. Clear? So it's 14.3%. Then we have to do the same calculation for the market value. Back based on market value. Right? Back based on market value. All these are same, but since you all are writing, I'll also write down. Right? So sources of finance is there. You have share capital, you have retained earnings, then preference capital, then this. So cost is already given. It's 18%, 18%, 11%, 8%. But now here you have to take the market values instead of taking book values. Why? You are going to take the market value back. So you could see market values for the share capital. You have a market value, but for the retained earnings, you don't have a market value. It's obvious. Then preference capital, right? The same value is there. And the bonds also, you have the same value. market values, right? Individual cost components. Like this. You have the weights here. You need to get the weight. Finally, so you can make an assumption here is that you are not going to consider the return earnings to calculate the WACC since it does not have a market value, right? Since it does not have a market value. So then you can, yeah, nothing to remove since you don't have a value here. But just calculate the weights. Yes, online students, is this properly visible, Tala? Can you understand this properly?
Yes, sir. Yes, it's okay.
So what about the weight here? Weight is how much? As a percentage? Yes. 69. Yeah, could be. 69%. Here you don't. Here. Now you will actually you will study an answer, right? If you can tell, you can imagine that I can also tell that. How when it comes decimal? This one, right? 7.69, okay? Right? 7.69%. In here then? 0.3. Sorry? 0. Is it 38 point. Oh, it will be the difference between 100 minus the summation of these two. How much? 23.08. Two values from one student, the remaining value from another student. It could be more than 100. Huh? Okay, anyway, it must be equals to 100. You know it, right? Then cost of capital simply. Here, this is your A. Here, this is your B. You need to multiply your A with B. Yes. What comes here? 69% into 18%. How much? Very good. 12.4. Okay, good. Then here. Zero 0.8%. Okay. 0.8%. Here. 1.8%. Total answer. Point one. 15.1. 15.1. Now this is the WACC. Understood? Now here the book value of WACC is 14.3 and the market value of WACC is how much? It's 15.1. Right? Now the learning point is the market value of your WACC, right? The market value of your WACC would be high if the market values are high. Right? The WACC calculated based on the market value here is 15.1, which is higher than this. Why? Because the market value of some of the financial instruments are higher than the book values. That is why you are getting a higher market value for WACC. Okay. Right now you got to know that you could use book value or the market value to calculate WACC. Sometimes most of the people are preferring to use book values when calculating WACC. Why? It's already available. If you look at this, so if it's already available, and it is very easy for you to get the understanding because if you are the person who prepared it. And also some says it would be better to calculate the WACC based on the book value. Why? Because your investors are looking at your financial statements and they make their decisions most of their decisions based on the annual report. And other market determinants are also there. So since this book value could be better. But on the other hand, some says market value are fine. Why? It reflects the actual position of the company. Actual position of the company. But when you are going to do adjustments for the market value, you need to repeat it. Because today's share price is not tomorrow, even for the evening as well. Right? So you need to continuously adjust your capital structure if you are using market values to calculate weighted average cost of capital. So this is what you can see at the end of your lesson. Market value versus book value. Right, so this is how you simply calculate the weighted average cost of capital. Could be calculated based on the book value to the market value basis. And before you are going to calculate the WACC, you need to know your cost of equity, cost of bonds, as well as cost of preference shares. So online students, is it clear for you all? You can have your lunch. It's exactly 5 minutes past 2. According to my watch, it's because I made that decision by looking at my watch, and I am providing the result based on my looking at my. Okay, yes, online students, we are going to meet sharp at 12:30 local time.